Hey, what's up, Market Moose? Mike from the Moose on the Loose. How are you doing this Monday morning? So today we're going to talk about Dollarama. They reported their earnings not too long ago, and the stock dropped 4 or 5%. Some investors are worried because of the comment from the CEO. But first, let's take a look at Dollarama's performance over the past few years, right? Almost 300% return in the past 5 years. Like, kind of crazy. The stock is trading close to the all-time high and right now trades at 40 times the earnings. Like, P/E ratio of 40, that's quite expensive. And it's probably one of the reasons why the stock was down on earnings day. So whenever this happens, first, that's just noise. It's not necessarily news. Just don't go crazy. I mean, 4%, would you really rush and stop everything you do right now because there is a big discount at Best Buy for a TV giving you 4% discount? Like, kind of crazy, right? You won't do that. So same thing with the stock market. That doesn't tell you anything. So the first thing I do most of the time is I just look at the earnings to see what the numbers were at. And actually the quarter was quite solid. We're talking about revenue up 10%, earnings per share up 14%. And one thing I really love about Dollarama is the ability to grow organically. So comparable store sales, so the existing store last year versus this year in Canada was up 4.9%. So 3.9% increase of number of transaction and 0.9% increase in average transaction size. So this is how you see if the existing stores are healthy or not. One other thing that was in that quarter is, of course, the company completed the acquisition of the reject shops. So 395 stores in Australia. They're saying that they have a similar business model over there. So they're going to work, of course, on building some synergies, creating a better store, and then expanding by opening new stores. Speaking of which, they actually opened their first Dollarcity store in Mexico. So this is another sign of expansion. So now, why in the world the stock was down with all those great news, right? Because everything that I just said right now, everything that I've looked in the press release sounds quite positive. Well, the thing is, the management team said, well, we kind of feel that the consumers are looking at their budget a little bit more. They're tight. They're likely going to spend less moving forward. And then boom, that was enough saying, oh my God, we are already expecting that damn recession is not coming in Canada. And now Dollarama is telling us, yeah, it's going to slow down a little bit. But really, is it going to slow down Dollarama for the next 5 and 10 years? And is it overpriced? Those are the two questions I'm asking myself, because right now I'm in the process of building a full position in my portfolio. So a full position for me is 3% of my portfolio in a single stock. Ideally, I want to manage roughly 30 positions. So I have some great winners that I can continue to run. So those are a little bit higher. But most of the time when I want to add a new stock, I want to have it about 3%. And I'm just buying share here and there as soon as I have money, depending if it's in my Smith Manor account, I have it in my pension plan, and the goal is to gradually get there to that level. But at the same time, I'm buying a stock at 40 times the earnings, trading nearly the all-time high. So does it really make sense? Well, let's take a look at all the growth vectors this company has to see if it's justified or not. Because usually when you see a high P/E ratio, there is a chance that the market is expecting a lot from that business. So as I told you, one of the biggest growth vector for Dollarama is organic sales and opening new stores. And opening new stores has been the narrative for several years. Actually, since 2012, they had 1,200 stores, and 13 years later, they are now close to 1,700. So the real number is 1,665 stores at this moment. The goal going forward is to, in 2026, is to open between 70 to 80 new stores. Keep in mind that a store within the first 2 years of opening generates about $3.2 million in revenue. It costs about $900,000 to build, and there's a 2 years payback. So as soon as they open new stores, they're getting profitable very, very quickly. The target by 2034, so in 9 years from now, is to reach 2,200 new stores. So we're talking about more than 500 stores in the next 9 years, about 60 stores a year. So pretty much in line with what they just have as an objective right now. So if you're looking at the graph at this point from 2012 to 2025, in those 13 years, they added 465 new stores. And now they're planning in the next 9 years to add another 500 new stores. And based on their business model, based on their expertise, I would say it's kind of fair to say that management is probably know what they're doing and they're doing it very right. So they're applying the same playbook over and over. And this is a recipe for success. I love when I find a business that is able to find a good recipe and just repeat it over and over and over. But there's more. It's like an infomercial. That's a great growth vector, but there's a lot more. So Dollarcity, they own a major stake in Dollarcity. Yeah, sorry, I just checked. It is 60%. So 60% in Dollarcity. They opening new stores across Central America as well. They set foot into Mexico. As of June 30th, 2025, they had 658 stores, and their goal is to get to 1,050 stores by 2031. So it's adding another 400 stores. So you can see here that they have that playbook in Canada, but now they're successfully applying the same playbook in other countries such as Colombia, Guatemala, Peru, El Salvador, and now in Mexico. So it's very, very exciting to see that they are able to grow their business not only in their country, but outside. But wait, there's even more. Like I'm telling you, this is like really like an infomercial. Recently, as I just told you in the introduction, they acquired an Australian dollar store called Reject Shop with 395 stores. And again, their goal is to apply the exact same playbook. So first, they're going to clean up those stores. They're going to improve them. They're going to use their economies of scales. They're going to use their own products because that's one key metrics for Dollarama is they are able to improve their margin a lot because they are selling their own products. And then they're going to expand in Australia. So now they can expand in Central America and Australia, and they're still doing well in Canada. When I think about all of this, at one point, I think, well, it's kind of like normal to overpay, if you want to say, like pay a premium for this kind of business. And this is not financial advice. I'm not telling you to buy. I'm just sharing with you my thoughts about why I'm doing this with my portfolio. When I look at the dividend triangle, I'm going to end with this. We have double-digit revenue growth, like roughly 11% per year over the past 5 years. Double-digit earnings per share growth as well. We're over 20%. That's kind of crazy. I expect it's going to slow down a bit because there's a limit of like how much margin you can expand, because that's one of the things. If you have revenue growing at 10% and then you have EPS at 20, well, of course, there's something that you're doing more to increase the profit per revenue, but there's a limit to that. So it's probably going to keep growing double digit, but a little bit lower than that. And yes, it pays a very, very small dividend, but we're talking about almost 16% dividend growth rate over the past 5 years. So that's kind of crazy. At this stage, though, it is offering the lowest yield ever. It is trading at a high PE ratio compared to its average. The average over the past 5 years is around 33 times the earnings. Now we're at 40. But here's the thing. Recently, they increased their stake into Dollarcity to 60%, and now they're expanding. Recently, they bought the Reject Shop, and now they want to expand in Australia. And on top of that, they continue the existing playbook of opening new stores in our country. So overall, I see a lot of double-digit growth coming up for Dollarama, and this is why I am building this position. If you want to know how to read through earnings and make sense when the stock price goes down, even though the earnings are great, well, I have a free webinar on September 18th. You can register for free at moosemarkets.com/webinar. We're going to look at how to read quarterly earnings to make sense out of them within 15 minutes. So clear cut. You're going to know what is important. You don't have to read like 10,000 pages. You're going to save a lot of time. You're going to build on knowledge and you're going to build on conviction. So you can register again at moosemarkets.com/webinars. I'm going to see you there. Until then, don't forget to stay invested.